Welcome to Neighbor. My name is Lynn Corm. I'm your host today. And we'd like to thank our sponsors, Stacy Subaru and Media Room Productions. And our guest today is Dan Yates from the Brattleboro Savings and Loan. Welcome, Dan, and thanks for joining us.
Thanks, Lynn. It's nice to be here.
Dan, we'd like to start our programs with you telling us a little bit about yourself. So fill us in on what brought you to Brattleboro, how long you've been here, and so forth.
Sure. Back in the spring of 1990, I was working at a bank in Greenwich, Connecticut, and my wife and I had thought often about moving to Vermont or possibly the Southwest. And a call from a headhunter saying, do you know anybody that's interested in a commercial lending job in southern Vermont? Brought us up. I went to work for the Merchants Bank in May of 1990. Was in Brattleboro until 1993 when Merchants transferred me to Bradford, Vermont, when they acquired some failed banks. Mm-hmm. And I spent the next 12 years trying to find a way to get back to Brattleboro. 2005, met with George Haynes, and here I am.
And it's been so 2005, it's been 2 years,
3.5 years.
3.5 years now. Were you at the bank at all first before you became the head of the bank, or
Yes.
were you? So you worked there first too.
I did. I came
under
in
George.
July of 2005 to step in as the number 2 person in the bank, mm-hmm. head up the commercial and other lending areas, and essentially run the day-to-day operations of the bank. Okay. And then took over as president January 2nd of 2008.
Okay. January 2nd. So you've been at it a whole year.
Yes.
A year plus and a month, almost a month.
Exactly.
Welcome and thank you.
Thanks.
That's great. Banking is the hot topic right now.
I know. I picked a heck of a time to become president of a bank.
I think, first of all, I'd let you tell people how the Brattleboro Savings and Loan is different than the banks that we're hearing about on the news. What I don't think you're caught up in any of this, the problems that the banks have, or are you?
No, and really the banks in Vermont, for the most part, have avoided a lot of the problems that we're hearing about in other parts of the country. And I think particularly the Brattleboro Savings and Loan, because we are a local bank, we are mutual, meaning we don't have any stockholders, don't have the pressures that some of the other banks have for providing dividends and other returns to investors. We just stuck to our bread and butter, which is helping people get mortgages to buy their homes, finance their business, and we just operate locally.
Didn't most banks have that kind of a profile when banking started a long time ago? I mean, a long time ago. Until, did banks always? When did banks start having shareholders and having people invest in that way? When did that happen?
Gosh, I think shareholders in banks goes back to the very early days of banking. Certainly mm-hmm. after the Great Depression and the banks that survived that, mm-hmm. you saw a lot more shareholders. In the 1980s, the savings and loan crisis occurred when a lot of the mutually owned savings and loans decided to become public banks, sold stock, all of a sudden found themselves with tons of capital, and what do we do with it? And started making very risky loans.
So a repeat sort of what we've had going on now.
Well, Marx said that history has a tendency to repeat itself.
And which certainly
here we go again.
Here we go again. Okay. I think it would be important if we talk about defining issues. We talked about this a little bit before we started talking. Because all these terms are being thrown around, and I think a lot of people don't understand what they mean, and I've had to question, well, what does that mean? If the banks start with nationalism as one of our first ones. If the banks become nationalized, what does that look like? What would that do?
It would change the face of banking forever. Essentially, mm-hmm. it means the government steps in, becomes the owner of the banks, of whichever banks they nationalize.
And so do you think that are they talking now about that, well, the government does have a stake in some of the banks because we've given them money.
Right.
Which I understand will have to pay back. I understand it's something like, from what I've read, I might not have this right, the first 5 years there's an interest rate of a certain amount that's reasonable. If you don't pay it by 5 years, I think it is, or 9, I think it's 5.
5 years, and then there's another 4-year period. I forget what the terms for the second half are. The first
But
5 years, it's 5%,
uh-huh.
and you're actually not allowed to pay it back unless you're paying it back through a new stock offering.
Oh.
Otherwise, you are prohibited from repaying it. But 5%, if you think about it, on the surface doesn't sound like much when you compare it to borrowing rates. But when you think about right now, every dollar we have for which we have no specific use and we invest in what's called overnight funds, we're only earning 3/100ths of 1%.
Mm-hmm. Well, I figured the borrowing is so cheap right now. 5% is a pretty nice return.
Sure.
Yeah.
For a bank such as ours, if we had an interest in tapping into those funds, as opposed to becoming a public bank and selling stock, it would be much less expensive for us to access the so-called TARP funds, or a capital purchase program, and pay the 5% instead of underwriting costs of a stock offering and things of that nature.
And this nationalism that's going on as you're seeing it today, a bank has to choose to be part of that. The government cannot dictate that you participate.
That's correct. It's all voluntary. You apply. The application is amazingly simple. I've looked at it.
For the government, huh?
For the government, it's essentially a 2-page document that you
Amazing.
fill in the blanks. They make a decision as to whether you get to participate, and you get between 1% and 3% of your risk-weighted assets. So for Brattleboro Savings, if we were to participate, we could conceivably see a capital injection of up to about $3.5 million. But at this point, we have no intention of participating.
Uh-huh. And after that 5 years, the interest rate jumps.
It does, although I'm not sure what it goes to.
I wonder if the payoff is the same restrictive payoff as it was before. I mean,
Well, I think after the 5 years, it opens up your options for paying it off much more than in the first 5 years, which again is just through a stock offering. The other risky thing about this is there's a section in the agreement, the dreaded Section 5.3 they call it, that essentially allows the Treasury Department to change the terms of the agreement at any time, in any way, without any prior discussion.
so you're held hostage.
Right.
And banks such as Chase, I believe, or Citigroup.
Citigroup's taken huge amounts of money from the government.
They're stuck with it, yeah.
Right.
Let's talk about how that happened, but I think we need to keep defining terms. Liquidity is thrown around. The banks don't have liquidity. What does that mean?
Liquidity essentially means, or a lack thereof, that you don't have enough cash to meet the demands of your depositors or to fund loan requests that you have to fund. IndyMac Bank earlier this summer was a classic case of what happens when you don't have enough cash to meet your obligations. There's a panic. People come in, I want my money. We don't have enough cash
to give them.
We don't have access to borrowings either through the discount window at the Fed or through, say, the Federal Home Loan Bank. And then the government has to step in and shut you down.
Wow. But on that end, the government has the liquidity piece, keeping people from panicking, raised the FDIC, the Federal Deposit Insurance
Yes.
level from $100,000 to
$250,000.
And so that should stop people from being too concerned about
Well, I think
that.
so, because that covers such a significant percentage of the average depositor around this country. The other piece that a lot of people aren't aware of is that for this period, which runs through December 31st of 2009, as long as a bank has decided it will participate, which we have, all non-interest-bearing transaction accounts, checking accounts, there is no limit on the insurance. So, for example, if you had a non-interest-bearing personal checking account with $5 million in it, your $5 million is covered by the FDIC.
No one's, that's the first I've heard that.
They're not advertising it very much, but
most checking accounts have a slight interest. I think don't check. I mean,
yeah, most
slight.
accounts are now accounts and pay 39 basis points
Would
or
those accounts
19.
wouldn't be eligible for
They would
this
not
then?
be eligible.
So
Right.
you have to be basically prepared to put your money in a mattress, although it's a safe mattress.
That's right.
Yeah. Well, at some point I was talking to one person, and they said it's, you know, a lot of people have pulled money out of the stock market and so forth, and they probably have put it in banks. And at some point, that money's going to go back into the stock market.
Sure.
And it's a matter of engaging when that point is.
And we've seen a tremendous influx of funds in the last 6 months.
People saving more?
People are saving more, which is good and bad. But people moving their money from the stock market, people moving their money from large banks, coming back to community banks, feeling a sense of, I know the people here, the decisions are made here, management lives here. It's not,
You aren't tied in with the federal government any more than you have to be
or
with
your
FDIC and so
parent
forth.
company's not in a foreign country,
Right.
as so many of the banks now are.
So they're owned by foreigners, all these banks.
Well, a lot of
interesting.
them, if you look at Citizens Bank, and I'm making no comment about the quality of the bank because I think they're good banks. Citizens Bank is owned by the Royal Bank of Scotland. Bank North is owned by Toronto Dominion. While it's not a foreign bank, Chittenden is now owned by a bank based in Bridgeport, Connecticut. So the local control, I think, is something that we're seeing a great diminishment of.
It's interesting how banks have just been gobbled up in just different times. Just it's these spurts of gobble going on
Yes.
that happen. They're really so interesting, and you wouldn't think that banks would be such a vulnerable business, but it really is.
And a lot of it has to do with efficiencies. As it gets more and more expensive to do things, banks are finding that by consolidating, they can continue to pay the dividends to their shareholders and reduce their costs. So there are economies of scale.
That's been the big impetus for this kind of stuff. Okay.
And personal greed, I believe.
So this stimulus package that's coming out, how do you see that? The first one that came out under the Bush administration, $720 billion or something like this. They're saying half of it's spent and nobody knows where it's gone.
Right.
How did that happen? Do you have any idea
Well,
what's
I
going
think,
on there?
Sure. I think it was essentially the TARP program allowed banks to apply for these funds, and they quickly dispersed about $350 billion of it. The idea was to get banks to lend again to try and stimulate the economy. Many of the banks simply set the money aside for a rainy day. Will there be more loan losses that they have to recognize? And some banks use it the funds to acquire other banks. Not using it for the purpose that
Congress
it was
had
originally
intended.
intended.
And I guess it was written in such a way and in such speed that nobody realized that they would do this.
Well, I think that was one of the most ridiculous things about it. Personally, and I'm not an economic expert, I was opposed to the bailout. I'm a believer in free market economy, and businesses fail, banks fail. Some people may think that we can't allow that to happen, but I don't agree with that.
Well, I've heard that argument. However, there is that argument. They're so big that the ramifications would be a ripple effect to the whole economy. Did you see that not as a problem? I mean, it would be a problem, but how big is too big? I mean, if they're not using it to lend out, again, it sounds to me like they might not have needed it as much as we thought.
Right. Of course, then, when some get bailout money and go off on junkets to California or pay out big bonuses, it makes the American people even more cynical.
Yeah.
And I don't know the answer, Lynn. It may be that the implications of no bailout could have been far worse than with the bailout money. But that's a crystal ball that nobody has.
And that's the interesting thing about economics. You would think by now we would know if you do this, this happens. If you do this, this happens. But you really can't tell, can you? In some ways.
You can't. And Ben Bernanke is a great student of the Depression and all the things that happened. And applied a lot of what he learned from studying that to the current situation. But the difference is it's not 1929. The world is a very different place.
Right. We have a lot of pressure just even from competition overseas.
Right.
Yeah. Well, you and I both have read a letter article in the in the Wall Street Journal by David Roche, and he talks about the ultimate cause of this, and he said the ultimate cause is social behavior and excessive spending,
Right.
putting excessive spending forth, and then he has a thing called the proximate cause, so which says that excesses finances through liquidity created in innovative ways and in huge proportions. I'm not quite sure I understand exactly what's going on here. So can you tell us the difference between the ultimate cause that he's talking about and the proximate cause of this
Well, the proximate
situation?
cause I think that he refers to is the hybrid mortgages that were developed. There was a great push in the 1990s, 1980s even. I guess it goes
I
back
think it
that
was
far.
77, 78, under Carter administration.
For more people to be able to own homes. And how do we do it?
Yeah.
Because some people just can't afford to own them. And they started to develop hybrid mortgage products, what they called option arms and interest-only loans. And a lot of these loans were really designed in some ways for people who were very savvy investors and said, I'm going to buy this house, I'm going to hold it for 3 years, and then I'm going to sell it, and I'm not dependent upon the sale of this house for my livelihood, and they would get an interest-only loan. What eventually happened was people who might say could afford a $100,000 home, now they're offered an interest-only loan. It's interest-only for the first 3 years or 5 years.
And then it balloons.
And then it balloons, or it converts to a repayment schedule, thinking, though, well, now they can afford a $300,000 house because they're only paying interest, and it's at a teaser rate. They'll be able to sell the house or refinance it before this trigger date comes along.
Is that's sort of, you think that's the mindset
And
that people went into these things with?
Absolutely. And it was a way for people to create a new type of investment vehicle. They securitized these loans, sold them. There's a great joke about selling them to small towns in Norway. That these securities, if you will, which are nothing more than junk bonds, were sold all over the world. And it financed people buying homes that they should not have purchased.
Now, if I wanted to buy one of these junk bond things, basically, were the rates that much higher that how could companies offer these at a higher rate when they are getting so little, they weren't getting interest on their money?
Well, they would. The rates on the loans were real at the time, and then they would separate these into what they called different tranches, and they would usually keep the worst quality for themselves, but then they would sell these other bonds at a premium, collect the fees, essentially covering their risk.
Covering their risk and loss.
And then the risk of loss on these other tranches goes to the buyers.
And Fannie Mae and Freddie Mac are in this mix somewhere in this country. They used to they advertised themselves as being offering loans to low-income people. However, from the stuff I've read, they did a worse job at that, or had fewer of those kinds of loans than a typical bank. And but so they were buying up these junk, buying risky loans, and actually Congress even forced banks to make these loans.
Well, there's pressure on banks to make sure that under the Community Reinvestment Act,
But that's under the Carter administration.
that we are reinvesting our dollars back into the communities, and that we are making a concerted effort to make sure that we are loaning money to low and low moderate income people. And that's fine if they qualify. But the problem was they didn't really qualify.
Well, didn't they take away the qualifiers?
Well, Freddie Mac and Fannie Mae came out with automated underwriting programs that all the banks were required to use. And it wasn't unusual to see somebody, you input the information into the automated underwriting system, and their debt-to-income ratio, which historically and traditionally, your housing expense, that's your mortgage payment, your taxes, your insurance, should not exceed 28% of your gross monthly income. And we would see loans coming back that were no problem, put it through with 115% debt to income ratio.
So there's no way they can keep that going.
How does it work? But nevertheless, Freddie Mac and Fannie Mae would take these types of loans, and the banks or mortgage lenders said, this is fine because we're not taking the risk.
Freddie and Fannie is.
Freddie and Fannie,
and they're guaranteed by the taxpayer, right? That they really weren't, but they sort of were in people's minds. It's a quasi thing.
I think because there was a sense that it was a government-sponsored entity, both Freddie and Fannie, so they'll never fail. But they had stockholders.
Yeah.
And the stockholders lose out.
Well, the stockholders made big for a while, though.
Sure.
Yeah, when everything kept rolling. And then I've heard, too, that if you as a bank, let's say a bank in Detroit wanted to open a branch in a low-income neighborhood and service that neighborhood, if you didn't have a good enough ratio of giving out loans under questionable things, groups would boycott the bank and protest in front of the bank saying, this bank is just here to take advantage of us.
Right. They're here to take our deposits and
not give us any money or not give us any loans. And so you as a bank, you almost couldn't win. It was a PR nightmare, I believe.
in many places it absolutely was. I think we benefit in our proximity because we don't have those kinds of neighborhoods.
Yeah.
I remember when I first got started in banking in Stamford, Connecticut, the bank that I was with had an unwritten rule that we didn't make loans south of Interstate 95 unless it was right on the water and the big old homes. Otherwise,
too risky.
Unofficial redlining is what it was. And that's what happened. Banks would then say, oh, I want a branch in the south end of town, but we just want the deposits, and we want to collect the fee income from the overdrafts, but we're not going to make loans to anybody there.
So how do you get around, you can see where the government wanted people to have access to cash to be able to better their lives, and yet businesses weren't willing to take that risk. Banks weren't willing to take that. What is the model that would work in that situation to be able to screen people who are willing to work and you are more reliable, but just might not have the resources at that time in their lives? Is there any model out there?
I don't know that there's a model. I think if we return to fundamental sound underwriting, which most of the banks in Vermont have always stuck to, we would avoid a lot of these problems in the future. Yes, there's pressure. If you look historically, John Sununu was a proponent of greater regulation on Freddie Mac and Fannie Mae because he was concerned about how loose things were becoming. And yet you had other members of Congress, such as Barney Frank, who said, no, they don't need any further regulation, and we need to get more homeowners. And
and who wins? And that's a difficult argument because you know how that game's played. If you don't vote for Barney Frank's vision of things, you're against women and children.
Right.
And you're a demon. And
exactly.
And now everybody's out in this, out in the street, and we have huge problems.
Well, look at the rate of foreclosure in this country, and the loss of value of homes. And
yes.
Who wins? The banks lose because they've made the loans. The homeowners lose because
their values have gone down.
The values have gone down. They're facing foreclosure and eviction. The investors lose because the value of the bank goes down.
But another factor in this too is I think when everything was going up, because you could get money so cheaply and not really have to pay it back, you had to pay it back, but you weren't easy to get out of that. It drove up the prices of housing to really unsustainable levels and quickness, which was a fake environment to begin with.
Well, we saw this in the 1980s.
Yeah.
Absolutely.
I remember how fast it went up, yeah.
When I was in Connecticut, I can remember a customer coming to me saying, I need a $15,000 short-term note. What do you want it for? It's just the 10% down payment on a condominium I'm buying. Where is it? Danbury. Who'd buy a condo in Danbury for $150,000? Oh, no, I'm not even going to close on it. He says, I've already sold the contract, so I only need the $1,500 so I can go to contract, and then I'll turn around and sell it for $60,000.
Just flip it.
Just flip it. And we saw the values of real estate rise unrealistically. tax laws changed, so investment in real estate was no longer that attractive because of the changes in depreciation rules. And I remember in 1993 when I was transferred north and was looking for a home in Quechee, they were telling me that the average price of a home, single-family home in Quechee, had fallen 25%, and the average price of a condominium had fallen 40%.
Wow.
So we're seeing the same kind of thing again, but on a much larger scale.
And so I guess we're not getting back to this article I mentioned, which I don't know if we'll get to that or not, but it's interesting how this boom and bust thing is part of our makeup and fueled by government rules as much as anything. Tax changes and regulation changes and tweaking here and there. Let's get back to your free market
Well, certainly an
thing.
encouragement, and Mr. Roche's ultimate cause, if you will, the spending piece of it, is that with the tax law changes, certain interest is no longer deductible, so
So you don't go there.
so you don't go there. So what do? I'll take a home equity loan, and I'll buy the car with a 15-year home equity loan or home equity line of credit, and I'll pay my credit cards off with a home equity loan. And people don't stop to think about, I'm paying for the next 15 to 30 years
For
for
a card
something,
that's going to last 4.
right, or a meal
5.
I digested a month ago.
Yeah.
And now that $100 meal is going to cost me $500 after I pay all the interest back. So, and we are a nation of spenders. Up until recently, as you commented on saving, we had negative savings in this country.
Really?
Which was also something that happened at the time of the Depression, because the Roaring '20s, people were
Everything was going great.
spend.
Yeah. Well, the spend part is interesting because that's part of our. You said there's a bad side to not spending. You know, spending, shopping, so to speak, makes up 70% of our economy.
Right.
And if people don't shop, this is the result.
Well, and if you look at the Consumer Price Index, I think seasonally adjusted in December, we actually had a negative 0.7%.
Right.
Shrinkage. So, yeah.
It's,
But things have to cool off, and recessions aren't the end of the world.
No. Well, it's interesting because if the government steps in, they'll make some kind of a rule, in my opinion, and tweak it, and then that spins off into unintended consequences here or unknowables over here, whereas if they just let it figure out by itself, I think it would figure out better without all kinds of extra layers of problems.
Oh, I agree. I think if you look at almost everything the government has ever gotten itself involved in, it never turns out well. You know, the old joke of, hi, I'm from Washington, I'm here to help, is run. Exactly.
Those are,
Exactly.
what are they, the 7 scariest words around? Good old Reagan, yeah. Well, I think that does it. I think we've hit our time limit.
Wow, that was fast.
Yeah, that's what it does. And I only hardly touched on some of this good bank, bad bank business and how to maybe get out of this problem that this author went into. We were hoping to discuss. So we'll have to maybe see how long this goes and maybe have you back for another and try to be more disciplined and get to that issue.
I'd look forward to it.
But we thank you for joining us today, Dan, and we thank you for watching, and we hope you have a good day.